All right, so welcome to another video. Today, what we're going to do is we're going to go ahead and do a quick little update on the AMD earnings butterfly that we just did yesterday. So I just want to give you a quick insight on this one in case you were curious. I'm going to go ahead and just kind of quickly hop on over there. Don't forget, you can also check out our Discord channel if you like, right over here, link in the description to see some of the latest charts that I post and also some of the classes. Check out tradersfly.com. All right, so AMD released some earnings, sales jumped, shrugging off concerns about PC slowdown. So all of that looks good, and the stock popped. We went ahead and created a little butterfly, which was for a pop in the stock. And obviously with earnings, you could take a full loss on these trades because you don't know. It's a guessing game when it comes to earnings. You just don't know where the stock is going. But if you're looking to, risk one to make one scenario, eventually you're looking to kind of get out on top with the probabilities when you're looking at a sequence or a number of occurrences of, let's say, 100 trades. And sometimes you're actually risking even less to make maybe one, risking one to make two. And in that case, it's even a better situation. So in this case, we risked about 270. And we came out and made about 83, 84. So at the end of the trade here, and this is just a simulated paper account just to show you kind of the trade example here. Go ahead and do 169 divided by 270. So you could see the trade, came out to about a 62% profit, roughly around that 50, 60% range. And sometimes even if these things would have just stood still, you would have gotten out with maybe like a break even. If they overshot, you would have been like over here at a $90 range. But I want to show you how the implied volatility inflates quite a bit in some of these stocks. As you can see, they just inflate quite a bit, and that's what puffs up these butterflies and makes them really kind of interesting trades for earnings, because you're not risking a ton. And I did a 5 lot here. If you were just to do kind of one, just divide that by 5, 270 divided by 5, because it's a 5 butterfly spread. It's a $50, $54 trade per butterfly. So you could have just risked 50 to maybe make about 30, 40 bucks. So anyway, just as a starting point, you could see, and the way to properly exit these positions, you could go in and just do a single contract and go kind of one at a time to see if you can get filled at 79 cents, then 80 cents and so on. But it is kind of moving down on me right now, so you do want to push the order to kind of get out, because you can see right here it's pulling back. So I do want to pull the trigger fairly quickly. If it was holding steady, I could say you just let it hang out in this zone, because then you can have the theta decay a bit quicker. But here what you're trying to do is just, kind of get out of that trade quickly, because the butterfly's done, the trade has happened, the earnings are released. Just go ahead, pull the trigger, you're kind of out, and then call it a day. Even if you take a little bit of a quick hit on the pricing or the spread, it's just easier to just kind of get out of it as quick as possible. Now, paper trading, I will say, they do fill you a bit quicker than the real account or the trades. I did something similar also in let's say the Iron Condor side, which I already got filled on over here, and that one worked out fine as well. But anyway, as far as butterflies go, the butterfly trades, I like them quite a bit for earnings trades, because they're, very risk defined, and you can risk a lot less with those guessing game earnings trades. Again, you're just playing the probability odds. If you're doing 100 of these trades, that's kind of what you're looking for, is that at the end of the 100 trades, risking a tiny bit, you're trying to get, maybe 65% probabilities in your favor, and that's what creates the profits or probabilities on your side. So some of them will be winners, some of them will be losers, and that's just the nature of the business, especially on the earnings side, because they are a little bit more risky from a directional standpoint. It's not like a regular investment, because earnings is just a complete guess. So we're just trying to play the probabilities, and you can see already it just continues to move against me quite a bit right here. So we're just trying to close that out. So you might give it 5 minutes here to try and play around and see if it can actually hold it, but other than that, it's just get out once you see the the earnings happen, you get out unless it's in your sweet spot, and then you could try and work the trade a little bit, meaning like take off one contract, then take off another one a little bit later, and take off another one a little bit later, and try and just, take off some profits. But in this case, I'm just going to go ahead and try to close it out, because otherwise this thing could just continue to run against you. So I'll just push it again, just 2-3 pennies, and your profits then will diminish more and more and more the more you have to push it. So it's always nice if you can just kind of close it out for a nicer profit. You can see already now I'm at 111 over 270, so a lot smaller profit than what originally there, just in the meantime of talking and getting the video thing set up from the morning time. So anyway, that's what you want to do from a earnings perspective. That's how they work. That's how they operate. With the Fed announcement today, it's not a trade I would want to just stick into and be in, because it'll whip around. I'm going to try to just close this here off screen, I guess, because it's just a little trickier to close it out right now. There it is, finally filled. And then and then that's it. And that's how that's how the butterfly trades work and function. I have some other stuff in here from the earnings trades, how I hedged them off from, hey, I didn't know if it was going to go up or down. So this, I kind of neutralized the delta here. So if it popped, I would have made money. If it would have dropped more, I would have made some money, but this trade was at a loss. But you're just neutralizing the delta, so this way you're not overexposed long or short through earnings. And that's another way to kind of hedge off these positions and risk assets. Otherwise, you're too exposed for maybe a big pop or a big drop, kind of like a Netflix had a big drop. But obviously you could start buying dips on some of the stocks that oversold quite a bit. But during earnings, I always want to hedge off that risk, because if you're long and you're looking for upside move like this, and then you got earnings, what happens if it drops down? So what you do is you offset it by hedging, and you take a hit on theta and slightly on the Vega side. But you hedge off that theta right there, and theta is the biggest loss that you're going to have, and then you got a little bit of a delta wiggle that's going to happen as well. But at least if you got earnings, you're not going to get hurt too bad from some major surprise or major problem. Now sometimes that's good, like if you get a good surprise to the upside, but other times it's pretty nasty, so I usually don't want to deal with that. So anyway, that's just my thought. Hope you enjoyed this video from the AMD side. Truly appreciate it. Feel free to check out some of the freebies that I have available, and join the Discord channel if you like, and I will see you on the next video update. Take care.